All right, welcome to this edition of the Multifamily Investor Nation webinar series. We do weekly webinars all around multifamily investing and talk to you about what we're doing here right in our group with PassiveInvesting.com. So you can see I'm Dan Handford down here at the bottom, also on your video screen here, and I'm one of the managing partners of a group called PassiveInvesting.com, which you can see here. And you can go to our website and you can see a lot about us and our portfolio. You can also go and see our team. So you can click on this Meet the Team section here. We actually just recently updated this and categorized things a little bit, added some more team members on here so you can see everybody who's part of our team. We also have some openings available. So if you're interested in joining our team, you can click on this little button down here and see what openings we have available for positions. We have some investor relations positions as well as some acquisitions positions available, and several others that are opening there too. But you can go here, you can click on my picture here if you want to find out more information about me. There's a video that I did that'll share a little bit about myself. I am married. I have 4 children, 3 girls and a boy. I live and work here in Columbia, South Carolina, in a submarket here called Irmo, Irmo, South Carolina. My children actually are ages ranged from, I guess I'll just tell you their ages. It's 10, 9, 5, and 3. So we got definitely a busy household here. But guess what? We still make time to be able to do our investing in real estate, and looking forward to sharing some of the things that we're doing here at PassiveInvesting.com with you. If you're interested in some of our current offerings that we have available, we actually have 4 offerings available. We have 2 multifamily assets here. We also have a self-storage fund and a real estate debt fund that you can take a look at. And so the Ascend at Tamarack is actually located in Houston, Texas, in a submarket there called Katy. And then the Hudson Cane Bay is located in the Charleston MSA and a submarket there called Somerville. So you can check that out. And of course, we have the multi-asset self-storage fund as well as our real estate debt fund. I won't spend too much time on this, but you can go to our website, check out that information, and see what we have available there. You can also go to our properties page and kind of see some of the other properties that we have. There'll be multifamily, self-storage, and even some of our properties have gone full cycle. We have 6 assets that we've actually are in the process of selling this year. 2 of them are already closed, and then 4 of them are getting ready to be under contract and hopefully close between now and the end of 2021. Last thing I want to mention before we get started is the Multifamily Investor Nation Summit. I won't spend too much time on this, but you can go to mfinsummit.com and register for this event. The next one coming up is going to be January 20th, 21st, and the 22nd. So just under 100 days from today. Today is October 12th, 2021. You can see some of the speakers that we had at our June event, the June 2021 event. We're going to have a good number of new speakers as well as some returning folks at this event. You can scroll all the way down to the bottom and kind of see some of the topics that we'll have as well as testimonials. So please go there, check it out, and go register for that event coming up in January 2022. We also do that twice a year, so usually in January and June every year. So make sure you pay attention and go to that mfinsummit.com to figure that out. All right, so let's talk about single versus dual class apartment syndication structures right now. Okay, so first thing I want to do is go over what is the typical single class structure inside of an apartment syndication. Okay, so I'm going to share my screen with you and use a notepad that I'm using right now. That'll hopefully allow you to kind of see and visualize some of the things that we're doing right now, or some of the things that I'm actually going to be talking about. So in order to fully understand a single versus dual class structure, you have to really fully understand a little bit more about what a waterfall is, and also what a waterfall is, what hurdles are, various things like that. So we're going to talk about waterfalls, we're going to talk about hurdles, we're going to talk about preferred returns, we're going to talk about equity splits. We're going to talk about a lot of things today. And I know we have a short period of time. I'm going to probably spend about 15, 20 minutes going over this, and then I'll open it up for some questions and answers towards the end. And so the typical single class structure starts off with a pretty simple waterfall, if you will. Now, when you think of a waterfall, a lot of times we think about waterfalls and this kind of setup and think about things being a little bit more complicated, right? And they don't necessarily have to be. They don't have to be complicated. So I'm going to break it down for you. So when you think of a waterfall, usually we're going to think about like these different buckets. We have different buckets. I'm going to try to make this look a little bit like a bucket. There we go. We have different buckets, right? And inside of these different buckets, there's going to be kind of different reasons and maybe different sizes of buckets, you know. And so when you think of a waterfall, just think about it this way. The money that's coming into the asset, whether it be cash flow or when you sell the asset, it starts to go into the bucket, right? And then it's going to continue to fill up the bucket with cash, right? So as it continues to fill up that bucket with cash, if there's excess cash, then it's going to flow over to the next bucket. And then it'll continue to fill up this bucket as well. And then it'll also roll over to the next bucket and start to fill up this bucket, right? That was kind of a terrible drawing there of a arrow. So we're going to do this one here. And it'll continue to fill this one up. Now, there might be a certain point in time where it only fills up the bucket a certain amount, right? And then, of course, the waterfall stops. So even if there was another bucket down here, it will never get filled up because there's only a finite amount of this water in the waterfall, or what we would call cash flow in the waterfall. And so when you think about these buckets that we have here, the buckets get filled up until they hit what's called a hurdle. And so we're going to call this, I'm actually going to do this real quick. I'm going to erase this, what's inside of here real quick. Let me just do this real quick. This will make it a little bit easier for us. Oop. All right. So we're back to these clear buckets again, right? So when we get back to this thing, we're going to call this our preferred return bucket, right? Oops, I'm on the wrong pin there. Sorry about that. This is going to be called the preferred bucket, the preferred return bucket, right? And in this preferred return bucket is going to be where the LPs are going to get 100% of the cash flow. And we're going to call this, inside of a multifamily syndication, there's usually two types of waterfalls. There's going to be a cash flow waterfall, meaning what happens to the cash flow during the hold period throughout the entire hold period. And the second waterfall is going to be what happens to the cash when you sell. So when you sell, you have this lump sum of cash. What happens to that? How does that actually flow, right? And so for this particular example, I'm going to share with you just the cash flow waterfall so you can see this. You could also go to our YouTube channel and figure out and search for the syndication structures where we actually go into the different waterfalls. You just type in waterfall. We actually have webinars we've done in the past on these different things. But I wanted to give you a brief review of it so that you were aware of it before we actually moved on to these different single and dual class structures. So you have this preferred return, 100% of those cash flows goes to the investors, the LPs, the limited partners, till they get this preferred return. And typically, you might see it as being like a 7% preferred return, okay? It's a 7% preferred return. And then once this gets filled up, the hurdle, if you will, is going to be this 7%. 7%, you might just say IRR, right? So once your investors receive a 7% IRR, the money will now start to roll over into the next bucket. And the next bucket is usually split. It's going to be split up. So we're going to call this maybe a 70-30 split, right? So we're going to call this the 70% over here, 30% over here, and we're going to do LPs getting 70% and the GPs getting 30%. So this is a typical equity split. So after the preferred return, so we can see here, after this preferred return, we now roll over and you get this equity split of 70-30 split. So you get a 70-30 split once you actually reach that 7% preferred return. So there's obviously, not obviously, but there are, when it comes to these preferred returns, there are different types of preferred returns. There's what is called a pari passu preferred return, where it also has a catch-up provision for the GPs, and I'll explain that in just a moment as well. But there's also a preferred return, which is what we call a true preferred return. This example I'm showing you is an example of a true preferred return. So the true preferred return looks just like this, where 100% of the cash flows goes to the investors, and then it splits right after that 70-30 with the LPs and the GPs. A preferred return with a catch-up has another bucket that these actually go into. I'm going to draw it here for you for just a moment. There would actually be another bucket, and we would call this the GP catch-up bucket. Okay, this would be a GP catch-up bucket where the GPs are going to be getting caught up first to the preferred return, as if they were already getting their 70-30 split from the very beginning. So basically, after the preferred return and a preferred return with catch-up scenario, the LPs would get no more cash flow until the GPs were caught up as if they were getting the 70-30 split along the way. And then once they're caught up, then the rest of that money would fall down into this next bucket, which would be the splits that just continue at 70-30. Okay, I'm not a big fan and proponent of that. You'll see me talk about that all the time. I highly discourage passive investors from investing in groups that actually have this catch up. And it's primarily because right now, with the current market, it is very tight and very hard to make those numbers work. So I won't go into a lot of detail on that, but again, there's some prior webinars that we did that talked about this stuff. So you can certainly, figure that out find that out on our YouTube channel for some of those videos. But for this example, this is a preferred return, true preferred return at 7%. Once it achieves that 7% preferred return, this is the first hurdle. We're going to call this the first hurdle. Then it goes to this 70-30 split. Now, sometimes you can have it very simple, just like this, and it stops, right? 70-30 split, you're done. Now, the next hurdle here, which might be what we call a performance hurdle, let's just say this is a 13% IRR, right? This will be our second hurdle. So in this second hurdle example, once you're going to do 70-30 split until you get to that, until you get to this 13% IRR. Once you get to this 13 IRR, the cash now starts to go down to this next bucket. Okay, in this next bucket, the equity splits might change. They might actually go 50% to the LPs and then 50% to the GPs. So what we're basically saying is that the GP outperforms the asset, they're going to get a larger spread of the profits for outperforming the asset. So it's incentivizing the GP to do that. Now, in our group, this is a typical structure. 7% pref, 70-30 split after that, up to a 13 IRR, and then the rest of it is split 50-50. There's no more hurdles after that. There's nothing else after the waterfall with this. That's pretty much it. Now, with this is actually what we would call a single tier structure, right? Well, let's go over what we call the capital stack for a minute, right? So you can kind of see what these different structures look like. So when we're building a capital stack, I don't know about you, but whenever I was growing up and building Legos, and I'll admit that I still build Legos today because I have children, so I still use Legos. But whenever I build Legos, I actually build them from the ground up, right? I always build them from the ground up. And so when you think of the capital stack, think about it from the ground up. And so on the bottom of the capital stack, you're typically always going to have the most important investor, which is going to be your debt, right? This is going to be your lender, the bank. They're going to be providing the most amount of the capital stack. I'm actually going to change this a little bit because it doesn't seem like it actually does it enough justice, because they actually are going to usually be more than that. They're going to be usually 60 to sometimes 80% of the capital stack, right? Depending on your loan to value or your loan to cost ratio. So in this particular situation, they're going to be at the bottom of the capital stack. So we're going to call this the bottom of the capital stack, and this one's going to be the top of the capital stack. And so what you can see here, and this is going to be a single tier. So we're going to go over a single tier investment structure. In the single tier investment structure, you're going to have your common equity, which is going to be, we're just going to call this Class A. This is going to be common equity. And in this common equity slice, this is where they're going to have that 7% pref, and they're going to have a 70-30 split, and then eventually they're going to do a 50-50 split. Okay? So this is a typical kind of structure, right? Of what you would actually see in this type of a setup. So, and then of course, the next slice up here, we might just call this Class B. and this is going to be your GP equity, right? This will be your GP slice. So what you're going to be raising money from investors for is this slice right here. And this is going to be the equity that's being raised from the investors to be able to acquire the asset. Now, if we look at this capital stack, let's talk about this for just a moment, just so you fully understand this. But with this capital stack, what you're going to see is that the risk is different based on where your position is in the capital stack. Now, this is going to be important to understand this as we look at the dual class structure as well. But if we look at risk, the lowest risk is going to be down here at the bottom of the capital stack. So the closer to the bottom of the capital stack you are, the lower the risk you have. Now, if you look at it from a return perspective, same thing. You're going to have lower return the lower you are in the capital stack. And that's because it follows the same kind of risk versus reward scenario. So the more risk you have, the more return you're going to have. And of course, the opposite it happens as well. The lower the risk, the lower the return. Same thing. The concept works the same way here in this particular capital stack that we're looking at here. Okay, and so the lower you are in the capital stack, the lower your risk is. But the farther you go up in this capital stack, the higher the risk is. Okay. And now, and again, you want to fully understand this part, which I'm going over it when I go over the dual investment structure as well. So we're going to say higher return. It doesn't mean that it is a risky investment. It just means it has higher risk than the person below you, right? In this particular in a capital stack structure. So the reason why the debt, they're going to get like right now, you're getting like what, 2 to maybe 3% interest rate right now, because they're in the lowest portion, or in this lowest portion of the capital stack. So because they're in the lowest portion, they're going to get the lowest return, which is that 2 to 3% that you see right there. Okay. Now, when you go up the capital stack a little bit, usually like your common equity, your overall return, might be between what, 12 to, let's just say 20%. Just depends on what type of asset class you're in and what market you're investing in and stuff like that. But the overall return might be between 12 to 20%. Well, you're in a higher risk slice of the capital stack, and so you're going to get a higher return than the debt or the lender. So because you have a higher risk, you get a higher return than the lender. Now, of course, the highest risk position in all these capital stacks is always the GP, because they only get paid if your investors get paid, right? And so they're in a highest risk investment. And most of the time in a syndication structure, if the GPs are investing in the deal, which I highly recommend that you do invest in your own deals, and I also highly recommend if you're a passive investor that you only invest with groups that are investing alongside you. But that slice of the GP, they don't pay for it, right? So even though it's higher risk, they're putting all this sweat equity and time and energy and effort into this deal, and they're only going to get paid and see those profits if the deal outperforms. So they have the highest return, which I say it's the highest return because for that GP slice, they're not putting any money in, they're putting in their own time and energy and effort and sweat equity, if you will. And so, of course, it's hard to calculate the exact return on that because they're not actually putting any money into that slice. So you can't really calculate that. So I guess you could look at that and say it's infinite return, but that wouldn't necessarily be true either. I'm not a big fan of what people call infinite returns because I don't like that, right? Because there's always a way for you to be able to move that money from that investment into another investment and grow it even more. So it's not always just an infinite amount of return. So in your chat box real quick, let me know, do you understand this? Does this make sense to you? And did this help you understand, for one, what a capital stack is, but also the waterfalls, the equity splits, and the returns, and the preferred returns? I mean, we covered a lot of ground in these first 15 minutes of the webinar today, but there's a lot that we covered. So hopefully this shed some light on some information for you so you fully understand exactly what this is. And I like illustrations myself because it makes me be able to fully understand something myself. So hopefully these illustrations were helpful for you as well. Let's go on to a different structure here. We're not going to go into this much detail on this. Let's go over what we call the single tier. So this is going to be not a single tier. We already just went over that. Sorry. We're going to go over a dual tier investment structure. Okay. A dual tier investment structure, or a dual class, if you will. Okay. And so let's build this capital stack again. Okay. Visually, let's visualize this again. We're going to put in our lender slice in here. Okay. It's going to be our debt. This is going to be our debt or our lender. And they're going to get their 2 to 3% because they're in a lower risk investment, right? Remember, if we go back here, lower risk, lower return, bottom, top. I'm not going to write all that stuff down again, but I wanted to kind of just share it with you one more time. And in this dual tier, you're going to actually have a small slice carved out. And this is what's going to be called a lot of times this is called Class A, but it is a preferred equity slice. And this might be 9 to 10%. Let's call it 9 to 10%. Okay. However, when you are in this Class A preferred equity slice, because you were in a lower position in the capital stack, you are relinquishing and giving up any upside potential for the deal. Okay. That's kind of how that usually works. And then, of course, there's going to be another slice up here. And this slice is going to be our Class B. And this is going to be your typical common equity that we talked about on the slide before. Okay. So this Class B is going to be this slice right here in this Class A. So don't get the A and B confused here. It's not GP, it's just a different slice. So you can see here, we have our Class A, we have our Class B, and this is the common equity. Again, the common equity will say the same thing, 12 to 20%, right? Because they're going to have that upside potential. Now they're going to have this 9 to 10% that you see here is actually a preferred return. It's a pref, okay? It's a preferred return. So what that means is that Class A investors in this preferred equity slice are going to get paid first before anybody in Class B, right? And then whenever you sell the asset on the other end, these Class A investors also get their capital back first. So that's why they're in that lower risk position, because they get their return first and they get their capital back first, but they're going to be capping their return around that 9 to 10% in these syndication structures. The Class B, obviously, usually those will have a pref, so we'll call this one like a 7 pref, but this pref is only a pref over the GP. It's not a pref over the Class A. It's a GP pref, 7% pref over the GP. This 9 to 10% pref is a pref over the GP, but also over Class B, right? So you're going to get the 7% pref, and then overall return 12 to 20%. This is kind of like a overall return, okay? And of course, this one you should already know by now. This is going to be Class C, and this is going to be your GP slice. So this would be a dual tier investment structure. Now, you might ask yourself, well, how would I know which one of these I'm going to use? Am I going to use a single class structure or a dual class structure? Well, I suggest always trying to underwrite the deal with a single class structure first. So using this structure first when you're underwriting a deal is the first thing that you should do. Now, when you're underwriting the deal and you look at this deal and you go, you know what? I got really good cash flows, but my IRR, my overall return, that average annualized return is just lagging. One of the ways you can boost the return for your Class B investors, your common equity investors, is to try to do this type of dual tier structure, because the more shares that you put in Class A, the higher the IRR for Class B. Now, one of the other things it does is it also decreases the cash on cash for Class B. So this cash on cash return for Class B definitely gets hindered and definitely goes down, okay? And so let me just write this over again. It's driving me nuts. My OCD kicking in, folks. Sorry about that. So it's going to decrease your cash on cash return. So it's a kind of give and take. So typically what I like to see is if there's a dual tiered structure here, you don't want Class A. So do not Class A greater than, I'd probably say 40% on the high end. Preferably 40% of the capital stack, 40% of the stack, okay, for equity. So if you're raising $10 million, you don't want to have any more than $4 million in Class A for preferred equity. Now, preferably, I like to see it closer to about 20 to 25%. So preferably 20 to 25% if the deal still makes sense. And the reason why is because the more money you put in Class A, the more equity you put into Class A, the higher the risk it is for Class A, because then the more money you got to pay out, the more money you got to give back when you're selling the deal if you have more in Class A. Does that make sense? So preferably you want to have 20 to 25%, but no more than 40%. If you see a deal that you're trying to invest in and it's more than 40%, maybe even more than 35%, you want to probably make a pause there and see, is that really the investment that you want to invest in? That doesn't mean you might not invest in Class B, but Class A is losing its lower risk side of things because it's getting close to having too much weighted into that Class A. So which one is better for you? It really depends on the deal itself, right? It really depends on the deal. So first off, underwrite it for this single tier. See if you have enough cash flows there. See if you have enough return there. If you want to boost the return for your Class B investors, which right now we're seeing a lot of these dual tier structures because cash flows are usually decent enough where you can take some of those cash flows away and give it to Class A, but then you also have the ability to increase the returns for your Class B investors and be able to attract more money from those investors as well. Okay. For you as the passive investor, let's talk about that for a moment, and then I'll open it up for some questions. For a passive investor, it really depends on whether or not you want cash flows, high cash flows, and no upside potential, or maybe you want to you don't really care too much about the cash flows. You want to be able to be more growth oriented. Most investors, as far as passive investors, want more growth. So that's why you also want to have a higher slice in that Class B common equity slice that you see on the screen right here, that common equity. Now, if you're the type of investor where you're just like not sure, like I don't know if I want to do Class A or Class B, well, in our group at passiveinvesting.com, we offer the ability for investors to choose to do both. If they want to do what we call a blended return, so they could put 25% in Class A, 75% in Class B, or 50-50 or 70-30, however they want to split their investment, they can put that up, and they can split that up between the Class A and the Class B. And now they have this. What's really cool about that is now they have this kind of blended approach of diversifying their investment in the same investment, which is cool. So you have different risk profiles with Class A and Class B, the common equity and preferred equity, and you can now invest in both. So you're kind of hedging your protections of your investment in the same investment as well, which is pretty cool. Most investors, most operators and groups will allow you to do that. So you don't only have to invest in one, but you can actually do a blended approach and put it inside of both, right? That's a question you got to ask yourself. Are you more growth oriented, or are you more cash flow oriented? And how do you want to separate that investment in that particular class? So let me go ahead and open it up to some questions here. I see a couple of them coming in. Let's see. Iris got a question in here. With your past and current portfolios, how often do you reach the lower or last hurdle, and how does the investor know they have been reached? Is it explained or made known in any reports or updates with investor database? So in our investments that we put together, let's just go back to this waterfall here for just a moment on the screen. On a cash flow waterfall like we just did here, it's very rare for them to get down to this last bucket on a cash flow waterfall, okay? Because it takes a lot of money to be able to give to the investors and to us as a sponsorship group to get to this kind of 13 IRR hurdle, if you will, right? So typically you're not going to, even though this is in the cash flow hurdle, if it does happen, this is what would happen. But in a sale hurdle or a sale waterfall, that's usually where you're going to hit these return buckets. And of course, those are going to be shared with you as far as the overall returns whenever you exit and whenever you sell a deal, right? You're going to be able to see that you're actually achieving. If the hurdle's at 13% and you got a 15% return or even a 30% return, you know you're in that 50-50 bucket, right? So it's something that as an investor in those deals, you should be able to understand that and realize that as well, without it actually having to be explained to you. But obviously, ask your sponsor if they have questions, or you have questions for them. Ask them about that. They can certainly share that with you as well. In the scenario, Keith is actually asking, in the scenario, Go would have not put Earnest money, so not infinite also. In the scenario, the GP would have to put up Earnest money deposit, so not infinite also. Well, that's true, but Earnest money deposit doesn't actually go towards their GP slice here, right? It doesn't actually go towards this at all. They're gonna, even though they're putting up the Earnest money deposit, they're gonna get that back when they close, right? So and even if they roll it in, they're gonna roll it in probably in a common equity position. They're not gonna roll it in. They're gonna do that alongside the investors, not for their GP shares. Now you could do it either way, but in syndication structures, you don't typically see that. Okay, let's see here. Does Class A get split of profits when the deal is sold? No. So in this particular scenario, we have the dual tier. Class A gets a preferred return of 9 to 10%. That's it. They get no participation in the upside because they're also in this lower position of the capital stack. So they have that lower risk, and they're also going to get their capital back first. So they get the first fruits, and they get their capital back. So they're giving up that upside potential. Let's see. So when there are two tiers, it's financial engineering to make the deal pencil. Yes, Clay, that is correct. Good point out there. For tier A, while being higher in the capital stack is true, it's taking on equity-like risk or for debt-like returns because the returns are capped. Yeah, that is actually true. So if you look at this particular slice, you could also consider this slice. Some people actually call it mezzanine debt, right? I'll just abbreviate it here as mezz debt, right? The problem is that most of your lenders are going to want to approve the mezz debt because debt has to be paid if you get into a tough bind in the deal. The deal starts to not perform, you have to continue to pay the debt. But when it's equity, you don't have to worry about it being a loan to value ratio or loan to cost or anything, because on equity, if the deal starts to not perform, you just don't pay the equity slice, right? Hopefully you don't have to do that, but that's kind of how that works when it comes to preferred equity versus just mezz debt, right? And of course, this being preferred equity or faux mezz debt, if you will, then it is a higher risk investment versus the debt, which is why you have a higher interest rate, if you will. If you want to think about it that way, we have a higher interest rate. But then again, because it's technically mezz debt, I guess, mezz debt, then you are correct. It is capping those returns. All right, can you use the dual tier if you have a preferred equity involved in the capital stack? And if so, how would it affect the rates you would offer the investors in the dual tiers? Typically, if you have a preferred equity and a group that's going to come in, like an institutional preferred equity provider, they're not going to want you to have another preferred equity slice on top of that. You could, but again, it's probably not going to make sense for you to do that, because if you already have one preferred equity provider in there, you're already probably giving up some of those cash flows to be able to get the returns you're looking for. And so after that first preferred equity slice, you're usually only going to have one other tier, which is going to be that common equity slice. All right, in the scenario of dual structures, this is from John, has a couple of questions in here. Is there higher risk of capital loss for the Class B investors if the deal underperforms or goes south? Yes, that is correct. You do have a higher risk of that because you also have to pay up or pay that Class A investor first. So good question there. Next question here is, I got a couple more questions that have come in. I'm going to cap them right now, so don't type any more questions in because I won't be able to answer any more of them. So I do apologize. I know I wanted to kind of keep track on the time here. I'm already going over a little bit, so I apologize. How is depreciation allocated between the two class shares or multi-class deal structures? And should investors that have higher risk have higher allocation of the passive losses? So typically what you're going to see is depreciation is allocated based on ownership percentage, regardless of the class that they're investing in. So it doesn't usually follow those lines. Could you do that? you could allocate more to the higher allocation to those passive losses, but you don't typically see that. Usually it's just divvied up based on their ownership percentage. From a sponsor's perspective, why raise preferred equity from retail investors? Isn't it easier to just raise from an institutional source and deal with fewer investors? So the answer to that question is yes. It can be easier, right? Depending on your retail investors. However, usually in order to get institutional money to be able to go into your deal as preferred equity or however slice you want to put it, you're going to usually have to have some form of a track record, right? They're going to want to see multiple full cycle deals, multiple years of experience. And so for somebody first getting started, you're not going to be able to get institutional money. It's going to be very, very hard for you. I see a lot of newbies trying to chase after institutional money, family offices, preferred equity providers. They're not going to give you the time of day. Most of them are going to say they want to see some sort of track record. They want to see some sort of experience. And so when you're first getting started, you're going to have to raise the money from retail investors. The reason why I said it might be easier is that even though you are raising money from retail investors, like we have over 1,600 investors that are in the various projects that we have with our group at passiveinvesting.com, and we rarely get tons of questions from our investors. We try to communicate with them a lot of different things along the way, as far as having monthly email updates. If things aren't performing, we tell them, but we don't have a lot of investors just hounding us with a bunch of questions and causing us a bunch of problems or trouble, right? So, and when you say it's easier, I would probably beg to differ that it might not be easier to deal with institutional investors, because usually your institutional investors are going to want to see some like monthly reporting, quarterly reports. They're going to want to, make sure that you're hitting certain targets. And if you're not, there's going to be clauses in their contracts with that preferred equity, and they can take back the deal and actually control the deal and kick you out. So there's going to be some strings attached with a lot of your institutional money versus your regular everyday retail investors. Can you explain the pros and cons of hurdles based on IRR versus equity multiple? So you could certainly do it however you want. I don't really know if there's really any. I would probably say that the IRR is what most people do. You could do it based on equity multiple, but I think for investors, it's easy to kind of understand, okay, once I hit this return, there's going to be an equity split, right? When you do the equity multiple side of things, most of the time even though you're the software in the background that we actually use RealPage IMS software. It doesn't even give us the option of being able to use the equity multiple as a factor in those. I could be wrong, could be mistaken, but most of the time your waterfalls that are built out are going to be using an IRR, or they're going to be using an annual average, average annualized return, right? And so most of the time you'll see in these waterfalls an IRR, because it actually is about as close to the true return as you can get. That gives the investors the comfort of knowing that once they hit that true 13% return, then they'll be able to get that they'll be able to have that equity slice change. All right, let's see here. What are your thoughts on preferred return funds that are solely preferred equity in multiple deals? I have no problem with them. So if there's a provider out there that has a fund and all they do is place money in preferred equity positions, it could be a good thing. Actually, I'm good friends with somebody who actually has a fund like that, and they find people who really at the end of the day, they're getting to like, a week before closing and they don't have all their money raised, and they can go in and provide a large check of the large chunk of the capital stack and get a nice, healthy, return. And when you're coming in there to kind of save the day, you can command a little bit more with a fund like that. I think they actually get up close to like 12 to 13% for a preferred equity slice. But again, they're coming in at the last minute, taking a larger stack and commanding the deal a little bit more too. And they're getting people that are the day before closing that need money, and they can go in there and save the day instead of losing their earnest money and various things like that. So, you can certainly do that. You can certainly work with those people. It might not be a bad idea as you're getting started to have one of those funds on the sidelines that you can call on if you need them. They can come help rescue you in a deal. That's definitely something that you can certainly do. All right. Does the waterfall structure come into play when you refinance a loan for the higher amount because appraisal came back higher. Capital is returned to investors. What about excess money received? Yes. So there's in a syndication structure, you're going to either have one, two. Usually, you're going to have at least two. As far as the waterfalls are concerned, so we talked about the waterfall for the cash flow. We talked about the one for the when we sell the asset. That waterfall before when you sell the asset can also apply for any other type of capital event, right? So any other capital event that occurs, you can have that happen as well. We actually have 3 different waterfalls with our investment structures, and they're spelled out very clearly, bullet by bullet, what happens to the cash flows when we have the cash flows during the hold period, the cash that comes out of a refinance event or a supplemental loan event, and then a cash flow, and then what happens to the cash when we actually sell the property on the other end. So there's 3 different waterfalls, so the investors know, especially in this dual tier structure, what happens to those cash flows. So it's good to be able to think through that process of what's going to happen in each one of those things, because if you do a refinance and you're giving all the capital back to Class A, they might be liquidated out to zero and they get nothing in return for that, but they're sitting there in the deal and they don't really have any capital in the deal. So because they have no capital in the deal, they're not getting a preferred return. So it's like what we do in that scenario. When we do a refinance, we do an equal return of capital from Class A and Class B, so those Class A investors can continue to stay in the deal, right? Now, some people treat it a little bit differently. That's how we've chosen to do it because we feel like that's the most effective way to do it for our investors. And of course, when we sell, Class A still gets that preferential treatment of getting all their capital back. And then, of course, it's going to be Class B getting all their capital back. And then, of course, the returns going to the Class B investors for anything over and above that for those excess cash flows. All right. Well, I know I probably talked quite a bit and covered quite a bit here today. I want to thank you so much for being here. I know we've covered quite a bit in the small amount of time that we were together. I know it can sometimes when I go really, really fast, it can be a little bit intimidating, but I would encourage you to go back to the YouTube channel. We'll send this out as a recording. Go back to it, watch it once or twice more, really fully absorb it. Maybe even get out a piece of paper. Go buy yourself one of these Remarkables. They're remarkable, right? So everything I'm drawing on here you saw on your screen there, but these Remarkables are really cool, especially for taking notes. And we use this in our meetings. We're actually getting ready to take these things and use them in our meetings and really bring them throughout the entire organization to be able to help with a lot of organization and notes and meetings and stuff like that. But take one of these, even if you don't have one of these, take a notepad out, draw out what I just showed you, and try to teach somebody else this, right? That's how you're really going to understand and know that you learned this, and try to teach somebody else these different investment structures. And I think it'll go a long way for you. So I want to thank you so much for being here. The webinar, there's another webinar coming up next week. I already closed my screen down, so I can't share with you what the topic is for that. But make sure you watch your emails and look forward to that next webinar coming up. And we also look forward to seeing you at the next Multifamily Investor Nation Summit. So go head over to mfinsummit.com right now and don't forget to register. So thank you so much for being here. We look forward to seeing you guys next week at the next webinar.